The same process applies when price breaks a resistance level. After the breakout, you wait for a retest and rejection before entering a buy trade. We have seen how to trade the break and retest strategy in a trending market. Now let's focus on how to trade it in a range-bound market, where price moves between support and resistance. In a range-bound market, price bounces between support and resistance, showing no clear trend. To trade a breakout in this market, follow these steps. Wait for price to break the range. Wait for price to pull back to retest the broken level. Enter only after confirmation. Why wait for the retest? Entering immediately after the breakout can be risky because early buyers take profits, causing a pullback. The only safe entry is after price retests the broken level and rejects it. This retest ensures that price respects the breakout, increasing the probability of a successful trade. Let me show you something few traders notice. Before a breakout, the market often sweeps liquidity at the support level. Here's how it works. Liquidity exists below support because many traders place stop losses and buy orders there. The market briefly drops below support, triggering stop losses and trapping sellers. Once the liquidity is taken, price reverses sharply and breaks out in the opposite direction. Look at another example. This time, price is moving within a range-bound market until buyers break above resistance. But instead of continuing higher, price closes back inside the range. This is a clear liquidity sweep. A liquidity sweep like this signals that the range is ending and a new downtrend may be starting. But right now, nothing is guaranteed. This is just the first sign of a potential shift. If you miss the liquidity sweep trade, do not enter inside the range or after the breakout. As you can see, after taking stop losses at resistance, the market breaks below the support level, confirming sellers have taken control. But your job as a trader is not to chase the move, it's to wait for a retest. Why? Because at this point, you don't know what's going to happen next. As you can see, the market retraced back and retested the broken support level as new resistance. This happens because traders now see it as a key reference point to sell from again. Sometimes the retest happens, sometimes it doesn't, and that's okay. You need to shift your mindset about missing trades. If the price never comes back for a retest, don't see it as a lost opportunity. It just means the market is protecting your capital for a better setup. It's better to miss a trade than to enter impulsively after the breakout and lose money. Now that you understand how to trade range-bound breakouts with liquidity sweeps, let's move on to the price action patterns that confirm a strong retest entry. A retest alone is not enough. You need to see clear rejection at the key level before entering. Here are the most powerful price action patterns to look for. The first pattern to look for is called wick rejections. When price retests a key level, one of the strongest signals you can look for is wick rejections. This happens when the market attempts to break through a level but fails, leaving a long wick behind. Why do wick rejections matter? Wicks show rejection. The market tries to push beyond a level, but price snaps back, proving that buyers or sellers are defending that area. It reveals liquidity traps. Smart money often sweeps stop losses before reversing, leaving a wick as evidence of trap traders. The more wicks, the stronger the level. If price keeps testing a level but can't break through, it signals a high probability trade setup. When price breaks above a key resistance level and then pulls back to retest it as new support, a bullish pin bar can signal a strong rejection. A pin bar is a candlestick with a long lower wick and a small body, indicating that buyers are stepping in after the retest. Here's how to trade this setup correctly. You can place your entry just above the pin bar's high after it closes. This confirms that buyers are stepping in and price is likely to push higher. Set your stop loss below the wick of the pin bar. If price drops below this level, it means the setup is no longer valid. The best place to take profit is at the next key resistance level, where price is likely to face selling pressure. Besides pin bars, you can also use other candle patterns for confirmation. Tailed bars. These candles have long wicks, indicating rejection at key levels. Dojis. These are indecision candles that can signal a potential reversal, especially when they appear during a retest. The key is to wait for confirmation. When multiple wick rejections form at the same level, it strengthens the setup and increases the chances of a successful trade. Important note: what I've shown you here is how to trade the break and retest, but there's one key element you should never overlook: top-down analysis. Always start with a higher time frame analysis to ensure your trade setup aligns with the overall market structure. This helps you avoid trading against the dominant trend and increases the accuracy of your trades. If you want to learn more about top-down analysis, check out my channel. I have a detailed video that breaks down this concept step by step. Now that you understand how to trade wick rejections, let's explore another powerful price action pattern: inside bars. Look at this chart example. Price has been moving sideways within a range, showing that neither buyers nor sellers have full control. Then, suddenly, buyers step in with strong momentum, breaking above the range in a powerful move. Once the breakout happens, many traders rush to enter, expecting the market to continue higher immediately, but instead of moving straight